guys! Today we're going to go over how to appropriately account for a loan. By the way, that's Jill right there. She's not very camera shy, so she'll probably be around quite often. So, loans are an item that can be easily accounted for incorrectly. This is a common occurrence for items that affect the balance sheet, which are your assets, liabilities, and equity. The majority of folks without an accounting background are more familiar with and potentially only aware of their profit and loss. The incorrect way to account for a loan is to simply expense each payment as it's made. A loan does not qualify as a deductible business expense. However, the interest you pay on it does. It is important to set up the loan once the funds are received and appropriately allocate the principal and interest portions of the recurring payments. Let's go over an example using a $10,000 loan with monthly recurring payments that include both interest and principal. Creating a general ledger account. If you haven't already, you will want to create a new general ledger account for the loan. To do so, click on the gear icon in the upper right-hand corner, then on Chart of Accounts. You can also use the left-hand menu, clicking on Transactions, and then Chart of Accounts. Click New. Category type will be long-term liabilities if the loan repayment is further out than a year. Otherwise, choose Other Current Liabilities. We will name it Loan Payable for this example. Click Save and Close. Setting up the loan. The most likely scenario when obtaining a loan is to receive the funds by cash, check, ACH, and so on. This is a simple entry. Simply record a deposit. You will choose the lender as the received from, which you'll want to have set up as a vendor prior to doing this. The account will be the loan payable that we set up previously, and the amount will be the principal portion of the loan, which is $10,000 in this example. Let's assume for simplicity's sake that we are only dealing with principal and interest on this loan. Save the deposit. Making loan payments. For this example, we will pay the loan by a check. Our payee will be the lender. For the accounts, it will be broken out between principal and interest. For our example, the total payment is $500, with $350 being interest. The remaining $150 will go against the loan payable. Total payment for $500. This $150 payment will reduce the remaining balance outstanding. Here's an efficiency tip. Use your loan amortization schedule to set up all the bills once your loan is funded. You can set up each one with the appropriate date in the future and allocate the principal and interest for each according to the schedule. When you make each payment, you simply do a bill payment for the full payment amount. Loans may not always be as straightforward as this example, so if you'd like assistance setting up and accounting for a more complex loan, please contact me and I'd be happy to lend a hand.